Welcome to BWC News. I am Elizabeth. Hedge funds poured in on January 31st, building the largest ever short bet on U.S. bond futures on the eve of a Federal Reserve meeting as the ongoing U.S. debt ceiling impasse threatens to put selling pressure on the U.S. Treasury market, worried about the risk of hawkishness and a hard landing of the U.S. economy. The most important news this week was undoubtedly the Fed's first rate meeting in 2023, as the market shifted from focusing on how much the Fed would raise rates to how the Fed would define the terminal rate. In addition, the Bank of England and the European Central Bank will also announce their latest rate hikes. Just before this super central bank week comes, a legendary investor is pessimistically predicting that U.S. stocks are likely to plunge 50%. This Thursday, the Federal Reserve will announce its latest rate hike decision after 2 consecutive days of meetings. But the market has predicted how much the Fed will raise interest rates for a long time, with a 99% probability of a 25 basis point hike at the moment. This is the third consecutive meeting where the Fed has toned down the rate hike in a row, the opposite of what it was at the start of the rate hike. The big concern in the market now is how long will the Fed raise rates by 25 basis points and where will the terminal rate stop? The market now believes that the Fed should suspend rate hikes or even switch to rate cuts as soon as possible to save the economy. However, Fed officials are generally agreed to raise to at least 5% or more, which indicates that the U.S. rate hike cycle may be longer than everyone thinks. On the other hand, almost at the same time, the European Central Bank and the Bank of England will also announce the latest rate hike. A high probability will raise interest rates by 50 basis points, that is to say the future spread between the euro and the pound and the dollar will be further narrowed. The euro and the pound against the dollar will continue to rise, while the dollar will continue to fall. The dollar decline is only one of the adverse factors for the U.S. financial markets. In the view of a legendary investor, U.S. stocks also face a lot of uncertainty risk. Grantham had previously predicted the bursting of the market bubble 3 times, and succeeded. Now in a letter he wrote to investors, he once again predicted that the U.S. stock market may collapse, although in the last year U.S. stocks have fallen 20%, but he believes that this year U.S. stocks are likely to fall by up to 50% again. By the end of this year, the S&P 500 will fall to 3,200 points. He analyzed that the current valuation of U.S. stocks is still above average, and according to the trend line of the S&P 500, it should reach 3,200 by the end of the year. It's just that the U.S. labor market is still relatively strong, and China's reopening will give the global economy a boost, so it's possible to postpone the U.S. bear market, but the decline in U.S. stocks will not be absent. As the lagging effect of Fed rate hikes continues, the full impact of the recession will be felt by the second half of 2023, particularly in the U.S. bond and real estate markets. According to the latest data released by the National Association of Realtors, NR, on January 30th, U.S. home sales slowed for the 11th consecutive month last December as higher mortgage rates, soaring inflation and steep home prices weakened consumer demand in the housing market. On an annualized basis, U.S. existing home sales fell 34% compared to December 2021, the lowest growth rate since November 2010, when the U.S. was still in the throes of the housing crisis triggered by subprime mortgage defaults, and new home sales also fell 26.6% year-over-year and by the most since October 2021. As senior U.S. economist Michael Sidner said in a January 31st analysis, by some measures, the Fed's rate hikes have led to a housing market downturn as severe as the 2007 to 2009 one, causing pain for potential buyers, homeowners, builders and other real estate-related industries. Because for the Fed, they believe that depressed housing will help achieve the lower economic activity and inflation the Fed hopes for in the coming year, it is expected that U.S. home sales may soon fall below the levels witnessed during the last U.S. housing crash as they decline month by month. Meanwhile, as the U.S. housing market continues to face the weakest headwinds, the backdrop of soaring home ownership costs and a wave of falling home prices is starting to spread. A large number of sellers, including Chinese businesses, are selling their homes at reduced prices to facilitate deals and are busy shedding their hands on U.S. real estate. According to a report published by Real Capital Analytics, a U.S. real estate data research firm, in a January 28 update, Chinese buyers were active buyers of star hotels and commercial buildings in the U.S. for many years, mainly in Florida and California, but things are different now, as the Chinese buyers, private and corporate, of yesteryear have been in the market since last March when the Federal Reserve started raising interest rates. They have been exiting the U.S. property market early. Since the Fed started raising interest rates, and have sold off at least a net of about $16 billion worth of U.S. properties since the second quarter of 2022. Multiple key inversions of the U.S. bond yield curve are clear indications that the U.S. economy may be headed for a hard landing, which, combined with soaring interest rate costs and the U.S. debt ceiling in a stalemate and other multiple effects, will make at least $32 trillion of international capital likely to be withdrawn from the U.S. stock, bond, and real estate markets. It's the end of this video. Thank you for watching. Please subscribe to the channel to support. See you next time.